Hello, I'm Pat O'Hare, Editor-in-Chief of Briefing.com's Investor Service. Most readers have likely heard the term P/E ratio when discussing stocks. It's unlikely that they are as familiar with the PEG ratio. PEG is short for price to earnings growth, which is another way of assessing if a stock is overpriced or underpriced relative to its earnings growth prospects. The PEG ratio is a favorite measure of mine when starting to research ideas for Briefing.com's bargain hunting page, but like any other valuation metric, it can't be looked at in isolation as a definite measure of value or lack thereof. To compute the PEG ratio, you need two pieces of information. The first is the stock's trailing 12-month P/E ratio. That can be determined taking the stock's price and dividing it by the sum of the earnings per share reported for the past 4 quarters. The next component is the projected earnings growth rate for the next 3 to 5 years. There are complex models for determining the growth rate. A simple solution is to consult the Analyst Estimates page that can be found on Yahoo Finance, as it contains a growth estimate for the next 5 years for most stocks when you search by ticker symbol. Armed with these figures, you can then determine the PEG ratio by dividing the P/E ratio by the projected growth rate. As a general rule of thumb, a PEG ratio of 1 suggests a stock is priced to fully reflect its EPS growth. A PEG ratio below 1, then, indicates a stock is priced at a discount to its earnings growth rate, while the converse holds true if a PEG ratio is above 1. This is not a strict rule, however. A stock with a PEG ratio above 1 can still be viewed as a bargain, whereas a stock with a PEG ratio below 1 could still be considered overpriced. Remember, you need to take into account factors that could prompt an upward or down revision to consensus earnings estimates that in turn will influence the PEG ratio computation. And, as is the case with all valuation assessments, peer comparisons need to be made. Generally speaking, we don't get too excited about stocks whose P/E ratios are more than 2 times their projected growth rate. A final point to keep in mind is that the PEG ratio is most useful when looking at growth companies. The PEG ratio is not a good value gauge for mature companies with low growth rates. Well, that wraps up this Learning Center segment. Thanks for listening.